Investing can be tough, but I just might have a ray of sunshine for you. Taxes. I have an amazing strategy investors of any size can use to keep far more of your money, even if you don't owe taxes. But the funny thing is, it works best while your portfolio is in the toilet. This is a two-parter. The first part works for anyone. The second part works for crypto investors, thanks to a loophole, a perfectly legal one.
Mr. Simpson, this government computer can process over 9 tax returns per day. Did you really think you could fool it?
Okay, part one is understanding capital losses. Let's say you were fooled by a lunatic who convinced you to safely hold $20,000 of UST. Then when the King stablecoin began to collapse, you converted your $20,000 UST into $10,000. By making the trade, you just locked in a $10,000 loss. This is called a capital loss. It's the complete opposite of capital gain, where you make money on an investment. In fact, they are such polar opposites they can be used to offset each other, which is amazing for you. So you lost 10K on UST. You sent Do Kwon a threatening tweet. That's over with. But let's say earlier in the year you sold some of your Solana stack for a $15,000 profit, aka capital gain. Nice. But here's the beauty. You get to subtract your $10,000 loss from the $15,000 gain on your taxes, meaning you only have to pay taxes on the remaining $5,000. Not bad, right? Depending on your tax bracket, that could mean as much as $5,500 in capital gains tax totally saved. That money would have literally come out of your wallet, but not anymore. I mean, losing that $10,000 sucks, but this definitely makes it sting a tad less. This technique will literally save me $100,000 this year. But hold on. What if you had a loss this year, but there was no capital gain to reduce? Are you just shit out of luck? Actually, no. This gets even better, and we haven't even gotten to the loophole yet. Now, let's imagine another scenario where your friend Dill also invested $20,000 into UST, but unlike you, he trusted the lunatic king too much and held his UST until the bitter end. He lost all $20,000. Fortunately, he also had another investment that did well, securing him $10,000 in short-term gains. He went long on latex futures and totally knocked it out of the park. Just like you, Mr. Doe will be able to deduct his 20K in losses from his 10K in gains, but unlike you, he lost more than he gained. It turns out that's actually no big deal. He can use the remaining $10,000 in losses to offset taxes on his regular income. Seriously, we're talking about like wages, salaries, tips, bonuses, and interest income. There's just one caveat you need to know. He can only deduct $3,000 per year. So Dill can offset $3,000 worth of his income this year, another $3,000 next year, $3,000 the year after that, and the final $1,000 3 years from now. Here, depending on your tax bracket, that 10K write-off against income could mean as much as $3,700 in tax savings on your regular income. There's really nothing else quite like this. It's cheap and perfectly accessible to anyone. You don't have to be some kind of global elite to use this strategy. Now, if you're looking to report capital losses, just make sure to keep good track of all of your purchases and sales through the whole year. I'll have several apps and services I personally use linked down below for portfolio tracking, tax tracking, and net worth tracking. I recommend all of them. If you've kept track of all your gains and losses, then at the end of the year, you'll either give your accountant the summary report, or you'll fill it out yourself when you're doing your taxes through whatever electronic service you use. More technically, capital asset sales are typically reported on a Form 8949 before being summarized on your 1040. It's really not as intimidating as those forms look, but that's just how taxes work.
Why don't you explain this to me like I am an 8-year-old?
But the biggest key here is start tracking now. You'll forget that meme coin you lost $500 on, and the last thing you want to do is scramble later on. So check the resources linked below and start tracking your assets now.
Do it! Just do it!
Before we get into the loophole that only crypto investors can use, taking this strategy to the next level, I need to tell you about iTrust Capital. Sponsor break. iTrust Capital, the #1 crypto IRA platform offering cryptocurrencies within your retirement accounts, meaning you pay 0 tax on your wins. I trust Capital, and they trust me. In fact, they trust me so much that they're just letting me do whatever I want with this 15-second ad. So I'm gonna try to break the world record for saying the alphabet backwards. It's currently 1.66 seconds, so let's put the time on the clock. Ready, set, go. ZYXD. Oh, I trust Capital. Trust them with your money so they can trust me with my ad time. Now at the crypto loophole.
Loophole high five. Loophole.
There's speculation that this strategy will only be around for another year or two, so let's use it while it lasts. You know, I do have a stock loophole as well. We'll talk about that after this. Let's say you have a nice capital gain win of $20,000 this year. You bought some waifu NFTs that really paid off, but you also saw the value of your Ethereum holdings fall by $50,000 over the year. However, you think Vitalik's got it in him to turn this ship around, so you want to hold, which you can totally do, but you can actually save money while you're holding. Here's what you do. Sell. Seriously, sell your ETH, but then buy it right back. And here's why. When you sell, you incur a capital loss of $50,000 on paper. But thanks to how crypto laws work, you can actually just buy right back in and use that $50,000 loss for your taxes, meaning that $20,000 gain is totally wiped out and you'll still have $30K to spare. The crazy part is you can't do this if the asset were a stock like Apple or Google. This is because stocks have what's called a wash sale rule. The rule states that you can't rebuy the same asset you're claiming a capital loss on 30 days before or after the sale of the asset. In stocks, that loss is considered by the IRS to be artificial. And they're right. It totally is. You really shouldn't be able to reduce your taxes by claiming a sale at a loss while still holding the exact same asset.
It's called having your cake and eating it too.
So why can you do this with crypto but not stocks? Well, it all boils down to definitions. Stocks are considered to be securities, while crypto is considered digital property for now. There's legislation in the pipeline that would turn the regulation of cryptocurrencies over to this guy.
Excellent.
Sorry, I meant his brother. But fortunately, laws move slow, and it looks like we'll have at least until next year before any legislation gets passed. So you might be thinking, okay, I gotta save a little bit more in taxes on crypto than I can with stocks, but is it really worth all the trouble? Well, let's return to your $50,000 capital loss on the Ethereum investment and the $20,000 gain on those NFTs. The ones you definitely don't have a crush on. Let's assume your ordinary income and short-term capital gains tax rate is 22%. So we know that the $20K in gains is wiped out already from those $50K in losses. Boom, that's $4,400 in savings. Plus, you still have the $30,000 left that you get to use against your ordinary income, which means for 10 years, you get to write off $3,000 in income, equaling another $6,600 in tax savings. So you just saved a total of $11,000 in tax in 2 seconds by hitting sell and then buy on your down bad Ethereum position. Now, I need to say two things. First, this isn't financial advice. Please do your own research as well. And second, if you like this kind of thing, check out my membership site, Nova, link down below. It's like OnlyFans, but instead of getting hard, you get rich. But if you do get hard, no judgment. Making money can be exciting. There we have buy alerts like this, live coaching calls daily, private content, and a massive group of investors making money and trying to find girlfriends. Not only does it support the channel big time, but you get access to way more content, and I used the wash sale technique a few months back and detailed the exact specifics to my members who were able to do the same. That will be linked down below. I do have a few techniques that stock traders can use to kind of navigate around wash sale rules as well. It's not a crypto level loophole, but it can still save you a good amount of money. So like I mentioned with stocks, there's a rule that prohibits you from claiming a loss on an asset that's been replaced 30 days before or after the sale, meaning you can't sell your Google stock at a loss and then buy it right back using those losses on your taxes. But what about similar assets? Now we're on to something. You can legally sell stock in one company, claim the loss for tax purposes, and then buy stock in a different company within the same industry. They aren't considered identical, so no harm, no foul. Then once the wash sale window passes, you can sell the new stock and buy back the original. Now I know this isn't perfect, so I do have one more method that can allow you to get a little bit closer to buying the same exact stock back. ETFs.
ETFs.
ETF.
They aren't considered the same or substantially similar to stocks. So if you wanted to lock in a paper tax loss, you can close that stock position and reinvest the money into an ETF which contains the same stock. Of course, your exposure wouldn't be the exact same, but that's the point. The ETF is different enough that the IRS wouldn't consider your losses to be artificial. And once your lockout period is over, you can choose to either keep the ETF or close it and open a position in the stock that you originally had. Finally, you need to be careful. If you haven't used a tax loss harvesting strategy before, consult with your CPA to make sure you're in the clear, and try not to get too tricky. Crypto is pretty straightforward, but wash sale rules for stocks even outline that your spouse or corporation you control can't rebuy assets for you. Remember, only senators can get away with that.